In the earlier videos, we learned about why it was important to invest and the investment options available to you. The terms risk and return were used often. Now, let's understand what they actually mean. Risk is basically the possibility of something going wrong or contrary to your expectations. But what is the risk that we undertake when we invest our hard-earned money? Here, risk implies the chance or probability of the actual returns on our investment being different from our expected return. We tend to associate risk with loss. But why not think of it differently? It also includes the probability of returns being higher than our expectations. That's a nice thought, isn't it? Therefore, the greater the chance of the actual earnings being lower than our expectations, the higher is the risk. When you invest your money, you are exposed to different types of risk. Here's a look at a few of them. Capital risk. As a first-time investor, what would you fear? Possibly a complete or partial loss of the value of your investment. A capital risk is the risk that you might end up losing all or part of the money that you invested. Liquidity risk. Have you ever tried selling a house? It can be a time and energy-consuming process. So, the second type of risk you face is liquidity risk. It is the risk that you might not be able to convert your investment into cash quickly enough. With real estate, it could take you a long time. But to convert your Infosys stock into cash, it might take you just seconds. Firm-specific risks. When we invest in stocks through direct investment in stocks or through mutual funds and ULIPs, we can get exposed to what are called firm-specific risks. This can include competition, performing better than expected, projects not working out, a new product launched which is not accepted well by the market, the entire sector being affected due to government regulation. Market risk. This is the risk which affects not only a particular sector but the whole economy. For example, a change in interest rates or a slowdown in the economy affects many, if not all, investment options. Some other risks like foreign exchange fluctuations and commodity prices may affect a certain class of investment options, but in varying degrees. That was all about risks. Now, let's talk about returns. Naturally, you would expect to earn higher returns if you are taking on higher risks. The return is the money that you expect to make from your investment. In the earlier video, you saw that there are different levels of risk and returns associated with savings deposit, fixed deposit, real estate, stocks, etc. You earn higher returns if you are taking on a higher risk and smaller returns when the risk is lower. Thus, where you invest your money depends on your risk-taking capacity as well as your return expectations. You may think of stocks as risky, but there is a way that you can lower the risk involved in stock investing without lowering your returns.